All right, let's get started. I'd like to extend a warm welcome to the Kranz Consulting Cap Table webinar. My name is John Dollard, and I'm a member of the senior leadership team here at Kranz. We are absolutely thrilled to have you join us today as we delve into the best practices for managing your cap table, along with sharing some common pitfalls to avoid to maintain a clean capital table. For those of you who may not be familiar with Kranz Consulting, we have proudly served as the leading fractional outsourced accounting and strategic finance firm for the past 3 decades. Our journey began in Silicon Valley with VC fund administration in the late 90s. And at that time, we expanded to include 2 additional core practices, our emerging growth fractional outsourced accounting and technical accounting practice, serving thousands of private and public companies for nearly 30 years. Our featured speaker today is Dan Morato. Dan brings a wealth of experience to the table. Before joining the Kranz team, Dan held various leadership roles across diverse industries, serving both as a CFO and CEO. His career spanned private equity-backed professional service organizations and publicly traded technology companies. You can find Dan's full bio on our website at kranz.consulting. Furthermore, apart from Dan's insights, you'll have the privilege of benefiting from the viewpoints of our in-house experts, including Shannon Klingelhofer, who serves as a director on our technical accounting team, and Michael Berry, our leader in the emerging growth practice, which includes stock administration and cap table management. Before I turn it over to Dan, I want to let everyone know that we will end with a Q&A session, so please feel free to submit your questions through the chat room throughout the presentation, and we'll address them towards the end of the webinar. With that said, and without further delay, I'll pass it over to the virtual podium to Dan. Thanks, everyone.
Great, thank you, John. Thank you for the introduction. So we're gonna take just a journey over the cap table, what we really see happening in a lot of early stage companies. But these issues are not limited to early stage companies. Many of you will experience them throughout the journey of your company's development. So as John mentioned, we'll talk about the basics of cap table management. We're also going to draw upon some experiences that we've seen over the years, and these stories are real stories, and they keep on happening, so it's relevant to review them. We're really look to business risk and financial risk and how we can help mitigate those events that happen. We're going to talk about likely investments that your company is going to probably engage and leverage to fuel funding and growth. We'll circle back up with a recap of the best practices that will help us manage these processes. And as John mentioned, we're going to dive into a Q&A session. So with that said, next slide. When we start to think about the cap table, I think it's really important about we recognize what we're using it for. It's just not an administrative burden. You know, it's rich with information. It becomes a source of truth, and we're going to hammer this point and kind of validate it along the way in the discussion today. But it's a source of truth for your investors, your management team, and it's a resource for communication to your employees. A couple things that drive behaviors and changes to our cap table. We're going to touch upon the 409A valuation process. At the same time, we're going to start talking about one of the first engagements we'll be working through, or tasks that the company is going to embark upon when working with the cap table, which will be creating some form of grants for your early employees. We're going to take a little bit of a side conversation on the early exercise and 83B elections. We're going to talk about what alters the cap table. Those are really going to be at our stories, and we're going to see how those events need to be recorded and addressed. And we'll circle back to the management best practices. I will say that along this conversation today, we will circle back to every aspect nuance about how we want to manage that cap table. Next. So what does the cap table mean to us? Well, the obvious thing we discussed and we'll discuss throughout the conversation is it's a source of truth. It's your investment truth. And when we look to that and we look to how we manage what we communicate to the outside world, when we're talking to investors or we're creating financial reports, that's a lot to do with managing our business risk. And then there's the financial risk, right? We need to make sure we have a clear understanding of what available options are in our cap structure, such as issuing grants or future grants to employees, making sure we have enough stock to support programs. And then how do we manage this process? Well, you're going to manage it through your cap table. And why is this important? It's a great visual representation about what's going on. And I would encourage managers that this is a great tool to review on a monthly basis, definitely quarterly basis. And anytime you're going to make a change to your cap table, go through, review it. Make sure we know who owns what type of investments we have outstanding, making sure vesting schedules are on track or have been turned off, terminated when an employee leaves, and the level of investment we see with institutions. It's just a great review about the behavior of the company and what's going on in your equity structure. Next slide. So the cap table, it's only as good as the inputs. And what we would tell you as advisors is that the compliance matters, making sure you're doing things in a timely and accurate manner. So in the simplest term, it's a ledger of company ownership, right? Just to let you know by vehicle, by investment type, who owns what, when, and how much. When you start seeing about how it interacts with employees and how we compensate employees, we'll be looking at the sections with grants, options, warrants, what's outstanding, what's available. Those are all things we can easily go to the cap table and understand. And again, to the outside world and how we view our equity, it's a single source of truth. Again, the little nuance there, cap table is the ledger. It must tie to your equity position. That's a great test. Anytime you're doing a round, before a round, have a review done, make sure everything matches. Any nuances need to be addressed, and we'll speak to it later because it can negatively impact your valuation. Next slide. So let's talk about the interplay. I think this is really important and it gets lost on folks sometimes. You get, our startup companies, we work really hard. We get the system stood up, we get accounting stood up. The team has worked diligently, has secured funding, and we set up our cap table. And that's phenomenal. It's embarking upon the journey, but we're not done, right? We have to do a 409 evaluation. Why? Well, because we want to go out and we want to start attracting great talent. And that typically fall under some combination of a deferred compensation plan. The milestones, though, need to be contemplated. So either we're going to give out some warrants, or we're going to start a grant program. And what happens there? Well, you're going to create offerings to employees. You're going to extend an offer, and they're going to have some type of early exercise option, more than likely. And then an 83B election ensues. They accept it. You get board approval, and you have to update the cap table again. Anytime you issue type of grant letter or offer, we need to make sure that the option grants or the restricted stock or the warrants are recorded properly. We need to make sure that that vesting schedule is done. So we're going to go into this a little more detail soon, but I just want to show you the journey, the fact that we're touching the cap table every single time we do any form of grant. Next slide. I'm going to stay at a little bit of a high level on the 409 evaluation because we'll have Michael Berry, who's our practice lead for emerging growth. We'll speak to it in detail. He's quite a bit of experience in this area. But why is it important? Well, every time we do any type of valuation, or we're going to issue grants, or we're going to do a round of funding raising, we need to determine the company's common stock value as achieved through a 409 evaluation. It is also a guideline provided in the Internal Revenue Service for deferred comp plans. And by having a certified professional perform the 409 evaluation, it'll give you some form of safe harbor. Important notes, kind of exceptions. A 409A plan or evaluation is not a one and done. It expires. Expires at two levels. One, there's a sunset on it, right? It lasts a year. The other thing is anytime there's a material change to the organization, you've increased number of shares, you've received additional investment, right? That's going to impact your balance sheet, impacts your equity position. Therefore, that needs to trigger an additional 409 evaluation. If you're uncomfortable and something happens, go reach out to your advisor. We're here to help. But more than not, if it feels a little different, you're going to need a new 409 evaluation. Generally, a 409 evaluation is a required input for any stock-based compensation expense. Our technical accounting team deals with this all the time. We can follow up on that as well. I think the new thing that we're starting to see folks engage in is that they're contemplating looking to a 409 evaluation firm instead of a standard valuation service, only because the markets have changed so much, the inputs are so variable, there might be some value to having that done. So with that said, I'm going to turn the mic over to our good friend Michael Berry, the head of our emerging growth team, and has a significant amount of experience in navigating the 409 evaluation process.
Thanks. My name is Michael Barry, and I'm the practice leader for the emerging growth team at Crans. I've been in the CFO space with startups for about 5 to 6 years now, and I've seen a lot of things around 409A valuations. They quite often seem straightforward, but I'm going to take a few moments to share with you some of the pitfalls that I've seen. Firstly, it's about choosing a qualified provider. A lot of my clients defer to Carta because of the 409A valuation being part of the subscription level that they already have. So that means in effect that there is no additional cost to do the 409A. Carta valuations rely on technology automation, and I have seen a trend of my clients recently choosing more dedicated valuation firms for their 409A valuation. A separate valuer can be useful in that they understand the industry, they can apply the right valuation methodology, and you have a more in-depth detailed discussion with them following the draft report to get the valuation in a place where you feel it is appropriate. Very important is understanding the valuation methodology, the future cash flows, the current value of the company, its IP, all of the components that make up a 409A valuation, and that they're correctly and appropriately brought into account. Another idea is to keep in mind is the frequency of valuations. So a 409A valuation is current for 12 months, but that's only so long as there is no material change in the business. Usually this material change is a funding round, but it can be a number of other things. It could be a loss of a key person. It could be a change in strategy. It could even be taking on some bridge financing or some venture debt that changes the outlook, the balance sheet, and the runway that the startup is facing. These are all potential triggers for a new 409A valuation. It's worth talking to your legal counsel about when that trigger point occurs. Obviously, once a priced round occurs, that is definitely a trigger point. But some attorneys take a more conservative view in that once there is a term sheet or even just a draft term sheet offering for a funding round, that in itself might be a trigger for a new valuation. And of course, documenting the assumptions and the process, knowing in advance of the valuation what financials and what budgets you're going to submit is absolutely a worthwhile exercise, so that you're not making things up on the fly once they've been requested. So in summary, keeping in mind the right valuation provider, understanding the methodology that you can work with, understanding the business drivers and your ability to discuss and be flexible, and making sure that your 409A valuations stay current, not just to the 12-month limit, but also when there are any other triggers, such as a material change in the business. So now I hand it back to Dan.
Thank you, Michael. Greatly appreciated. Next slide. So let's drive this back to a real life experience, right? You're starting to onboard your first clients, your first employees, you're setting up your grant plan. There's a couple of communication points you need to sit down with your employees, right? Most are going to want to take advantage of the tax efficiencies, so they're going to opt for an early exercise, which allows the employee and founders to purchase your stock options before they vest at the strike price. Strike price being established by your 409A, that's done before you develop the grant plan. Second piece, it's an IRS regulation component. It's your 83B election, which allows the employee to pay taxes on their stock awards at the time they are granted. You go through that process, and now that they've accepted, they've signed, you need to go update your cap table and input those grants in there. I think it's important to note, we talk about the administration of this. Who owns this process? Are you relying on your legal counsel who might be managing the cap table? Is it your accountants? Is it your outside cap table finance professional? Could be any one of those. It could be someone in the management team. We would encourage you to make sure that you have a second set of eyes and you're checking these things off. Especially, we're going to talk a little bit later, in the conversation about the 83B election. People speak to this. Yes, we all recognize that it's the employee's responsibility, but that paperwork, that form needs to be filed within 30 days of purchasing your stock grant. The consequences are very difficult to manage at the employee and at the company level. So this just illustrates the real life example of what early stage companies are going to be going through. But every time you do a grant, you're going to be doing a 409 evaluation, and you're going to be updating the cap table for each individual that's participating in the plan. Great, thank you. Next slide. Key takeaways. What do we see when we take a survey of early stage companies that we've worked with and when they come to us? There's a couple call outs. It's always very consistent. People want to save a little bit of money. We understand that in the early stages. But Excel is not going to be a sustainable path for managing your cap table. At some point, you really need to move on to a purpose-built cap table solution. There's a lot out there. We can help you evaluate that solution. But advice would be get to it sooner than earlier. Sooner than later, you're going to really appreciate it. Second part, the processes surrounding it. Who owns what? Create and develop a cap table best practice and a review process. The standard review, when you're granting employees options or you're extending warrants, make sure you're capturing everything properly. You have the documentation, you have board consent. Make sure we have all that documented and saved appropriately. And here's the other piece. If something's different, if there's an exception note, if you have a question, don't sit on it. Get that addressed, have a formal process to escalate that to someone that can help you do it. And really what we're talking about is, go to your trusted business advisors. Make sure you have legal counsel that's aware of how your cap table is progressing, what you're trying to do, your tax advisor, and your CFO. Make sure that you have financial advisors that are able to connect your cap table to your equity position on your balance sheet. Next slide. So we have altering events. Happens all the time. And we're going to talk about some real life stories here. Employees leave the company, sometimes under not so good terms, sometimes just great employees just moving on. They've served their time, they did a great job. It's a great separation, and you hope to have them again. You have employees that are participating in a grant, and we discussed a little bit, but they forget. Someone fails to file their 83B, go through those. And then we have convertible securities and how to report those. And then we're just going to have a broad conversation and bring it back home about just, you don't capture all the information in your cap table and the consequences of doing evaluation on the basis of that information. So when we go through these stories, what I encourage you to think about is, we have business risk, obviously, we're going to have financial risk. And what are the mitigating steps we could have taken along the way to ensure that the cap table was up to date, or wrapping policies and procedures around our cap tables? Next. Let's think about this. What could go wrong, right? We're everything in the construct of thinking about timely administration and management of the cap table, and then the consequences. I think it's important to consider when we have consequences to actions, can we mitigate them, or some we're just going to have to live with? Next. So we go through this. How do we evaluate our progress, right? One, I would say self-assessment. Make sure you have a process. Make sure we get the right people. I think it's important to note about the people. You have internal people and you have external resources. Great to have segregation of duties. Great to have a second set of eyes. Next. Now we get the people. Let's make sure we have the right people doing the right jobs. Are they qualified to do that task? Do they understand the consequences? Do they understand what to look for? And let's make sure we have people providing some level of oversight. Great. Next. So this is our first true story. Probably not unlike an experience that many of us will have as we manage our early stage companies, or any developing companies for that matter. The cap table is not updated timely. In this scenario, what we have is we have a couple of engineers did a great job with the company for over 3 years, had participated in multiple grants. They decided to move on. They were very helpful. The company also compounded the operating model by using an online portal to help manage the option process, which is great. Gives employees easy access, see what's going on, easier to manage. So the two employees separate. 6 months later, the management team is looking to execute another round of grants, bringing on some new employees. They're about to go through their 409 evaluation. And what do they discover? No one went back into the cap table, stopped the vesting of the options. The employees were going in, probably not from a malicious intent, just going in and executing their vested options. So now you have a couple consequences. First thing you do is you got to pick up the phone and talk to legal, figure out what remedies you need to put in place. More than likely, you're going to have to refile your 3921 forms. And if you're going over, this process, this 6 months straddle 2 years, reporting years, you're going to have to go back and report your financial statements. And of course, you're going to have to immediately go into your cap table, stop the vesting, and make notations on what happened. So again, process, probably, in this case, HR may be processed, the termination letters. No one connected the dots with the folks that were managing the cap table that they had to make an update. Next. We talk about this story because it's so relevant. We do a great job. We get great talent. We get new people to the startup world. Maybe it's an employee, it's their first time in the startup. Filing tax forms is not everyone's favorite pastime. So maybe they just forget. They don't know what's important. It wasn't communicated clearly. But let's remember, when we're going to attract and retain great talent, we can put the grant process in front of them. They can do their early exercise, but we need to make sure as a management team that we're providing some support to make that 83D election form get filed. The consequence is that it creates a tax risk for the stockholder and the employee, more than likely, and the company. So upon each vest date, there's going to be some triggering. If the stock price is above the exercise price, now you're going to have to push through reportable income on payroll. So you're going to get a very shocked employee seeing capital stock appreciation and payroll, and they're going to have to pay taxes on that. Additionally, the companies more than likely have to pay some type of matching payroll tax on that, probably earlier than they anticipated, and they're going to have some reporting requirements. At the end of the day, this is a very uncomfortable position for the company to be in. It's tough to manage. Yes, it is the employee's responsibility to file, but the company needs to have, some education and support to make sure that these get done properly. Next. Now, this one's a fun one, and it happens more than not, especially when you have multiple people managing the cap table. They do a great job. In this case, what you have is you have double cash reporting and mysterious double entry. We had a situation where multiple teams of law firms were managing the cap table. They did a professional job. It was great. But what happened at one point during the journey, there was a conversion from the convertible notes to preferred shares. Both entries were reported properly. The first entry was not removed. And someone reported cash receipts on both. So we have a couple of plays here. One, your cap table is now overstated in terms of the cap structure. The note should have been removed. But we also have some type of indication that cash was received for both. Cash was only received for the notes. So now you have equity not matching. Equity was wrong in terms of the cap structure. Cash was wrong. How this was identified, our team was migrating the cap table from one application to the new system. So the consequences are you're going to have a cap table and a balance sheet that are not aligned. You're also, if you run the 409 evaluation, it's going to negatively impact the company valuation. So which means any follow-on series pricing, strike prices for option plans are all off. That's going to take a lot of undoing. So again, any convertible transactions, any changes, make sure that that always ties back to supporting documentation and that your cap table matches your equity section of the balance sheet. Next. It's kind of the statement of the obvious as we follow along in this conversation, that valuations that use outdated cap table information are incredibly problematic. In a simple adage, bad inputs are going to deliver very bad outputs. You know, it's simple. Your cap table is not up to date. You're going to result in a evaluation that's not indicative of the company's share value. How you leverage that is just going to be really drive the consequences. If you're using it for a series round, well, that's problematic. You're using it for option grants, that's problematic. You're reporting to investors, questions could start that you don't want to unpack at that point. So at the end of the day, if you got bad data, you're going to have a negative impact on your valuation. You could trigger IRS reporting requirements because of exercise price, grants, and for stock. So what I'd say to this, when you start to build and you start to go through the journey of raising your next round, always exercise a very healthy dose of professional skepticism about the integrity of your cap table. If it's been handed over from team to team, just do a quick review. Make sure it matches your balance sheet. Make sure that every major transaction you have, or for that matter, every transaction you have supporting documentation that matches it. Make sure you receive the cash payment for that equity position or for that investment. We don't want to be in a situation where we have, inflated shares or we don't have all the shares accounted for. There's very good hygiene to go through. There's great controls. We can help you do that, but your team can start with that as well. Next story. So if we kind of wrap up and we start to think about these stories and how they happened, there's protocols. There's some common sense we can deploy, right? Make sure you always update. Something happens, update it timely. Make sure it's accurate, matches the supporting documentation, and don't sit on exceptions. If there's an exception, escalate it immediately to the management team and make sure that outside advisors are brought into the loop if it looks incredibly different, we don't have the proper documentation. Second part, good healthy dose of skepticism. Make sure you get proper authorization and support for all changes. Note that going back and making amendments to prior grants it can be done. It's a very complicated process. And again, it falls under the process of exceptions. So anytime there's an exception, you want to make sure we escalate that through the management team and to proper trusted advisors. Matching principle. It seems like it's simple, and it is, but it takes work. And make sure your cap table matches your equity position on your balance sheet. That's something we do all the time. I review with my clients. We just want to make sure that matches. Even if it's off by a few dollars, it just eliminates the issues going forward. And it's also just a good protocol. Once that gets done, the monthly updates, quarterly updates just slide by rather quickly. And when in doubt, because there will be doubt, markets change, tools get more sophisticated, options develop about equity structure. If it looks different, and it is different, talk to your trusted advisor immediately, get their issue resolved and documented. It's going to save tons of time and effort down the road, and it really builds trust with your investor base. Next. Let's start talking about a handful of equity transactions and structures you're going to see. We all see these in the early stage through, I'd say through D-series. We see these structures, so there's worthwhile to dive into. We'll talk about safe agreements. We're going to do options. We'll start talking about restricted stock awards, and then we'll do a deep dive with a Kranz consultant on warrants. Next. So safe notes. I think everyone on this call is rather familiar with safe notes. I think the safe note discussion starts to get really interesting now that we start to see more offshore subsidiaries of companies in the U.S. that have raised money. The IFRS accounting treatments can be a little bit different, so make sure you understand those. But again, when we start talking about safe notes, they're just simple agreements for future equity. Been around for a while. We use those. We see them in the early stage seed rounding. Great tool. It's a legally binding agreement that allows investors to buy a specific number of shares in the future at an agreed upon price or at some point in the future when the startup has completed some funding round. Let's take a quick pause there. Just to understand that not all safe notes have the same terms. So let's take a step to the YC safe note history. The YC, the Y Combinator, created the YC safe notes. They were about 2013. Y Combinator is a Silicon Valley accelerator. What was so clever about that structure, it allowed startups to secure, as we talked about, seed investment without interest rates or a maturity date. It's also a very simple 5-page document. The only thing negotiable was the valuation cap. Anything that falls outside of that could be a safe note, but it could start to look like debt. So when we look at a safe note, one of the first things we're going to look at is the balance sheet. We're going to see if the safe note agreement, we'll review that to make sure we understand how it's raising capital. And then the next cut, you're looking at, hey, maybe equity or maybe liability. Obviously, equity will be in the equity section of the balance sheet. Liabilities, more than likely in current liabilities. And we report accordingly in the cap table. So if it goes to the cap table, it's similar to a convertible security. We're going to notate and make sure we understand provisions such as early exit, change of control, dilution, investor provisions you may see with discounts and valuation caps. Make sure you're clear on those. Make sure we have the documentation because it's going to drive reporting. And one other critical point, if it is classified as a liability, there may be an adjustment for fair value. It's a technical accounting process. It could hit your P&L that change month on month for each valuation. Make sure you have that down. If you don't have good guidance on that, go talk to your advisor. Our technical accounting team does that quite often. But again, more than likely, you're using a Y Combinator based safe note. But if anything falls outside of that definition, have it reviewed immediately to make sure you have the proper classification and you have the proper accounting. Okay. Next. Options. We talk about this a lot, and sometimes it doesn't get us the depth it needs, and we understand how it works with employee-based comp. But I think it's important to just discuss it, just two big components. If you're doing a service or performance-based option, grant, or plan, that's going to trigger some form of vesting schedule. Make sure that is in your cap table and it's clear. Also, as you grant those, because it can be done one-off, make sure you have enough stock to cover. Right? We don't want to be in a position, and we've seen this, where there's been a bunch of plans granted and they all vest. It's going to exceed the amount of common stock available. Good intentions again, but just make sure you reconcile that out. We're also, you see, and it's a little bit rare, it doesn't happen all the time, but you'll see a non-service or performance-based. That's going to be for sometimes other organizations, advisors, maybe some participating angel investors or advisors that are really helping you get off the ground. Please note, contemplate, don't give too much away, because if you grant a significant amount and they do the initial work, but then kind of walk away, you can be left with a lot of debt equity. Just look out for that. And then you need to understand it, track it, and be able to report on it. That's an important piece. The accuracy of underlying data. This really comes into play as you get more sophisticated. The stock-based and compensation expense that needs to be recorded. This is not, there's a lot of facts and circumstances. It's not rote. It can get complicated. There's stock-based compensation support plans or platforms you can see, such as Morgan Stanley ShareWorks and Carta, for example, can help you with that. But you're going to need a technical advisor to review that, make sure you're booking the expense properly. And if there's any questions, I would escalate that. There's guidance and there's support around that. Additionally, what you can see here in the world of granting options for specific services, there might be original grant terms that need to be modified. Again, it can be done. It's incredibly costly, and it's also complex. So make sure you get an advisor to help you walk through that process. Next. Thank you. Restricted stock awards. We're seeing these a little more. They're coming up. You're going to see specific employees will have access to them. It's a type of equity compensation. It's a grant with restrictions. The restrictions result in the fact that it's so thinly, or it's just not traded. So in theory, the value is zero. So there's upside. You see getting them. Founders and select advisors will get them. There is an 83B election component to these, so make sure that gets filed. The employees own the shares on the date they accept them, the grant, and there's some form of defined vesting terms have to be satisfied for them to trigger. With regards to the vesting, what we see is for vesting conditions, either there's a service commitment side to it and or a performance condition, such as the company will achieve standing up a facility somewhere, or there's a market component that you hit X number of customers within a certain period of time. So they're being structured in a very kind of goal-based component. Again, I think what can also trigger here that we need to dive into is make sure that it's clear about what type of compensation expense you're going to book, those facts and circumstances. As you can see, with regards to vesting components, can get pretty complicated. Definitely go get guidance on this. Next. Warrants. Warrants, we're starting to see a little bit more warrants. I've seen them given to banks. We've seen them given to consultants, issued to consultants, and it's a good tool. There's a valuation process because there's an exercise price. So you're going to leverage your 409A. When these get input into your cap table, make sure they're clear. Typically, when they vest, they're converted to common stock, but we've also seen them go to preferreds. So you have your 409 evaluation. You need to make sure that these get input into your cap table. It's just going to be a different group of individuals or institutions that are going to be the recipients. They get complicated in the sense, much like safe notes, you can account for these as equity or liability. So we need to make sure we put them in the right category in the balance sheet, accordingly on the cap table. And then, when we get to liabilities, if it's in that category, there's going to be an accounting implication. What do we record as an expense? And then we have to also look at impact on covenants, right? So if it's debt, it's going to hit working capital. We need to make sure that we understand any covenants we have with our banks. How we value these, because there's a fair market valuation component. There's two ways. There's a classical Black-Scholes model, and if warrants are highly variable, meaning there's a lot of different unique terms, probably going to have to call in a valuation expert because a standard model is just not going to pick up on the nuances of those variable components. So I want to keep the warrants at a high level because we're going to have Shannon, our Senior Director of Technical Accounting Group, speak to some nuances and a little more detail on warrants. Shannon has practiced as a CPA for over 25 years and is an expert in the technical advisory and accounting areas of these unique securities. Shannon?
Stan. Hi, this is Shannon Klingelhofer, Senior Director of the Crayons Technical Accounting Group. Appreciate the opportunity to be here. Just wanted to mention a few hot takes around warrants for your consideration. I think there's three main items. The first one would be the accounting for those. And within that, there's probably three buckets to think about. The first, will these warrants be classified as equity or liability in your balance sheet? One important consideration is, would that impact any potential covenants that you may have with bank arrangements. So that's just one factor to consider. The second one is once you've determined that balance sheet classification, what's the fair value of the warrant that you've now issued? That is generally determined either by one, more simple Black-Scholes methodology that we at Crayons can use to assist in some cases, or potentially, depending on the complexity of the terms of the warrant, you may need to go to an outside valuation specialist. Something to think about there. And third is probably the biggest thing. What do you do with all of this once you know the answers to fair value accounting or classification? Should the value be set up as an asset and amortized over, say, the life of the agreement? Does it end up being expensed on day one? Or does it get allocated as part of the proceeds you may have received when you issued the convertible debt along with the warrants? So all facts and circumstances drive the ultimate accounting, but a lot of things just to consider as you issue warrants and think about the financial reporting that you may be doing to either lenders, your board, or just internally to management. I think the second other big piece we just wanted to highlight is really just the consideration of these for corporate transactions. Again, depending on the facts and circumstances of the warrant, we see the warrants either automatically be exercised, they can potentially just expire upon a corporate event, such as an IPO or a change of control. And in some cases, we've even seen where these could be put back to the company for a cash settlement option. So a lot of things to consider, and just something to remind everyone that if in fact in this environment, the company is considering a possible transaction, to make sure that you don't overlook the understanding of the warrants and the impact that they may have. I think the third and final thing is, as you can tell by the first two bullets, there's a lot of nuances and complexities that you can run into for the warrants. And so the biggest thing there would just be to ensure you really have the understanding of the warrant and that it aligns with the business intent. Obviously, accounting will never drive key business decisions, but it is important to ensure that if you intended to, say, pay someone to reduce cash outflow, that you fully understand the long-term business impacts that it may have, both from a economic transaction standpoint or accounting. So, those three things, just the accounting, the fair value calculations, and just the overall business impact are just three things to think about as you issue warrants and ensure that they're in your cap table. We at Crayons have a great team of experts. Myself and my colleagues are here to help walk through any questions and or calculations that you may have. Please feel free to reach out at any point in time. We are more than happy to jump on a call, talk through facts and circumstances, and lead you down the path. So again, thanks for the invitation. Dan, back to you.
Great, thank you, Shannon. As we wrap up our discussion regarding equities and financing and how we support our companies as we're growing, all these, any type of equity, any type of investment is going to go through a review. They're all not equal. There's different complexities. So what we first tell you is that make sure you know your facts and circumstances. Make sure you start to contemplate the accounting to make sure we're handling that properly, and then make sure we're putting in the right category in the cap table. The next piece is anything we're doing regarding employees or new information or fundraising, we better get board consent. That gets really difficult to run down after the fact. We see that, and it becomes problematic. So make sure you always get your board consent for any activity you're doing. That needs to be rolled under the cap table. Supporting documentation needs to match the cap table. Offer letters, perfect example. Make sure we have that, all the elements that tie back to the cap table. If it doesn't, get it addressed quickly, which gets us down to our last point. And we just, there's a lot of remedies here. There's a lot of resources as management teams we can deploy and engage with. If there's an unknown, make sure you get an outside perspective immediately. The cap table and the consequences of it rolling forward become material in almost every event. Next. So to round this thing up, cap table best practices. Hopefully it's pretty clear. If it's not clear, please reach out to us and we'll walk you through it. But make sure you're always timely and accurate with any piece of information that we receive, right? It needs to get captured, document, and make sure we have proper authorization that gets back to board consent is always a great example. Make sure you have some type of formalized cap table process, whether that's, you review this summary sheet from CARTA every month, or every time there's an adjustment to the cap table, we make sure that, you know, 2 people within the management team review it with their CFO, go back to legal. But there needs to be a process. Who's in charge of, when an employee leaves, making sure that the vesting schedules are turned off? That should be clear. Make sure you review and monitor. You know, it seems simple, but yeah, the standard solutions out there have really good summaries. You know, take a peek at those every month and make sure you see that nothing's changing. You know, as a management team, small group, we know when things should change. We know when things shouldn't change. Great control. And at the end of all this, it's an imperative from your team to make sure you have trusted advisors that we touch upon the cap table. That goes from legal to tax to your CFO and your financial team that's providing you advisory services on that front. Make sure you know who they are and get comfortable, and make sure you know the issues that have gone on in the past, and make sure they're documented, and make sure you have that conversation with them, that you know where the ball's going. If you know what you're going to see down the road, it's super helpful to contemplate and start getting those processes and treatments set in stone before it sneaks up on you. Next. So we've kind of talked about the nuts and bolts, right? And we spent a lot of time on internal consequences and why we want to manage them, what the purpose is and the intent. But there's, you know, the outside is just as important, right? There's a reality. If you have an accurate and well-structured cap table, and you can speak to it and explain it and say, I have no exceptions, everything's notated, you're going to get, you know, it's going to pass the test of the investors. You're going to instill a lot of confidence. And that's just a great feeling. It also demonstrates that you've started with your equity structure and you've stayed with it. Your law firm is going to help you set that up. You know, your financial advisors as well. We know what those structures look like. If you can maintain those structures and live within them, it shows, again, a level of management and dedication to growing the company. And that's only going to pay off in spades later and develop credibility with your outside investors. It also shows one very important thing. They all know how hard cap tables are to manage. And if you come in with a clean, well-structured cap table, they know that you've taken the time, you've taken it seriously, and you've addressed issues. There's always going to be exceptions. There's always going to be issues. It's inevitable. Just get them addressed up front, and it's going to pay off in spades. Next. So thank you. And I know that we were opening the floor, and I know we've accumulated some chat. And let's see how we progress.
All right. Thanks, Dan. Yeah, Bonnie, I'll hand it over to you. I know we had several questions come in throughout the presentation. Bonnie, why don't you just pick perhaps the top 2 or 3 questions?
Certainly. One of the questions, what are the major changes in the way cap tables are managed today versus 10 years ago?
Michael, you want to respond to that one?
Sure, I can jump in on that. Yeah, the great question. The last 10 years has been quite big in the way that cap tables has been managed, or at least the change has been big. Going back a decade, certainly 15 years, everything was the purview of legal firms. There were paralegals charging $450 an hour to keep the cap table up to date. It seems like a safe space, and typically is, but it's expensive. And I have seen some legal firms make some pretty big mess ups of cap tables. Not to say that they all do, but they're humans just like the rest of us. Really, CARTA, ShareWorks have changed the game in terms of technology. A lot of the online, the ability of employees to have a look at their own holdings in real time, digital share certificates really has changed the way that options, that shares are managed these days. It's very rare now to see physical paper certificates issued, whereas a decade ago, probably more 15 years, was very much the norm, that you would receive your physical share certificate, you would sign a physical piece of paper for your options. That's all electronically workflowed these days. Another piece to consider, certainly when you're looking for who should be managing the cap table, is there is a certification. So it's a certified equity professional is the certification or qualification, and that specifically is around the ability to manage cap tables, the questions that fall out, things like 83B elections, what the 409A entails, all of that. So really has changed a lot in the last decade.
Thanks, Michael.
Sure.
Bonnie, what do we have up next? We have time for maybe one or two more.
Yes. So one of the questions is, do you have an example of a startup making a major error in managing their cap table, and what were their consequences? So I will take that. And just note, I am a certified equity professional, so I do have that designation. Dan had pointed out that company had double counted cash raised for their convertible notes and the associated converted preferred shares. So that potentially could have impacted their 409A valuation, but was discovered prior to the new report. A legal firm had entered in preferred shares into the cap table platform per the stock purchase agreement, but a year later was discovered that the preferred shares were issued to investors who had not paid for their shares. So the company did reach out to the investor for payment. That is part of my process. When I do receive a stock purchase agreement, I confirm funds received, dates received before entering in the preferred shares into the stock platform. Another example is a company had their HR department enter into the grants into the cap table software platform, and they used their vesting start date as their grant date. So all of their options issues were incorrect, and some had exercised their options. So their cap table was incorrect, and they also needed to amend the employees' tax forms. Let's see.
All right. Thanks,
And-
Bonnie. Yeah. Maybe we'll just do one more.
Certainly. Who is on the hook for 83B elections?
No, I can take that. So in simple form, it's the employee's obligation is on the hook. Now, they're responsible to file the forms within 30 days of the grant. But let's face it, right? The challenge here is that when you hire employees that look to management for guidance, that look to your organization. So it's just human nature, right? They're more than likely going to blame the organization. And then, so it's just not a compliance issue getting the form, but then it rapidly turns into an employee relations issue. So yes, it's the employee's obligation, but I think as managers, it's a unique process to the employee. We have to help manage that process and shepherd that through. And I think it's just important that, employees are your biggest resource. We just really want to take care of them.
All right. Thanks, Dan. Thank you, everyone. Hopefully everyone found this webinar very informative and educational. Following the webinar, everyone will receive an email in the next couple of days with a link to the recording. Please, by all means, if you have any further questions, feel free to send your questions to marketing@crayons.consulting.com. And we'll circle back with you as soon as possible. Thank you, everyone.